about your comment about the cash costs going up for mining in the big companies, I guess in the small companies as well. I'm just curious, is there any evidence that the big companies are actually mining the lower grade ores when the price is high, just the reverse of it, they'd high grade when the price was low? Is there any evidence of that?
Not that I've seen, but I think you're on the right track that overall, as somebody pointed out, the amount of new finds in gold have leveled off tremendously. So companies are increasingly either going down further or mining less productive loads. And that's one of the reasons why cost is going up.
So leaving their reserves with the higher grade ores on mine for the present time in case prices go down?
Well, I don't know that anybody's actually saying let's put the high grade to the side. I'm just saying they've mined a lot of the high grade. So now, by definition, they're into lower grades.
Okay, thank you.
Question back there.
I have a question for James Turk. What is the historical ratio between a barrel of oil and an ounce of gold?
It's about 2.2 grams of gold per barrel of oil historically. And that actually, I took it back to 1950, but it actually goes back a little bit further than that. It's just one of many things that you can actually measure the prices in terms of gold. But you also have to look at what you're actually measuring, because technological changes can improve things. If you measure the price of a computer chip in 1968 in terms of gold versus the price of a computer chip today, you would think that there'd been a massive deflation over that period of time, but that's because of the technological changes. So there are other things that come into play. But the most useful thing is to measure commodities against gold.
I'd like to pose a follow-up to, it is stunning when you look at your chart that the ratio of the prices of gold and oil is so constant over 60 some odd years. It makes you wonder if OPEC or the oil producers don't in fact think about the gold price when trying to set the price of oil.
I worked in the 1980s with the Abu Dhabi Investment Authority, which is that country's sovereign wealth fund. That's where I learned that ratio, Abu Dhabi being one of the biggest oil producers in the world.
Yeah, OPEC regularly leaks a rumor that they're going to start selling in gold. I mean, that's a rumor that I've heard at least 3 times in the last 10 years that's been officially leaked through the Wall Street Journal. Right? They never do it. But that's largely because OPEC's become hugely ineffective at doing their own job. But that, I think that eventually we'll start seeing that, and I think it begs the question: at what point do we see the industrial complex actually start thinking of gold as money? I mean, I think Steve Cunningham and I had a whole argument about that on the phone the other day. Right? I mean, that's a big gap between where we are today and sort of a world where people literally start pricing things in gold grams.
You have to remember that in Saudi Arabia, for example, there was no such thing as paper money until 1968. You would have to pay things with gold or silver. So it's still well ingrained in the mentality of the older generation and taught to younger people. It's also part of the religion in that part of the world.
And the old English sovereign was one of the currencies for oil.
That's right. I had a lot of friends in the oil industry, and they would tell me about stories where they would come with a treasure chest of coins to pay for their concession for that year to, whatever it happened to be. And that was a preferred coin.
Another question in the back of the room.
For James Turk to start, and you other guys can comment on it if you want. Would James comment on the advisability of holding your gold, however or wherever you hold it, A, inside the U.S., versus B, offshore, and then C, where would you hold it?
I get this question a lot because, as people are aware, gold was made illegal after being confiscated in 1933 by President Roosevelt and not being made legal again until 1974. When dealing with the future, there is no one right answer, but diversification is probably the closest thing to that answer. And as a consequence, to mitigate risks, I think diversification is an important thing. You probably want to, if you live in the United States, you probably want a little bit of gold in hand. But you also probably want a lot of gold outside of the United States because gold outside of the U.S. was not confiscated in 1933. But it's a very interesting question that you raise, Walker, because If you go to France, for example, they don't want to store gold in Switzerland because it's too close to the Swiss taxman. They'd rather store gold in Delaware. So, everybody has a preference as to where they think is safer. But I think the one answer is that you just want to mitigate your risk, and one of the best ways to do that is to have geographic and political diversification. Store some gold in Hong Kong, because if the U.S. Imposes on Britain the pressure to confiscate gold in London, the Chinese will very, very unlikely ever bow to U.S. pressure. So diversify your holding, and that's the best way to mitigate risk.
It's actually relatively easy to do that too. I mean, not only can you, when you're buying from a bullion vendor, they often give you a choice of a couple different places you can custody that gold, and there are ETFs that their whole shtick is we only custody in Asia, we only custody in Switzerland, et cetera. So, I mean, there are options if you're trying to do that.
As a follow-up to your comment, and if any of you wish, take the time this weekend, go Google the original decree during the Roosevelt administration that banned the ownership of gold, and you will wonder what country he was ruling. It's a very hair-raising, frightening document. And I think if you might add a few comments about what was the nature of that decree? Did it say that as of tomorrow, did you have a day, did you have a week, did you have a month before you had to turn over all your gold holdings? I mean, what was the prohibition exactly?
Yeah, I don't remember the exact time which you had to turn it, but the penalties were very, very severe if
You could go
did
to
not.
jail.
But you're raising a bigger question, which I think everybody should think about in this room. In the past century, gold was confiscated by Lenin in Russia, by Mussolini in Italy, and Roosevelt in the United States. Now, if you stop to think about what was the reason that they were doing it, it was to take gold out of the hands of the people. Because gold, as Warren Buffett's father said, gold is what controls politicians. If you give people paper money, you don't have control over politicians, and they can do whatever they want. So think about that.
AIER wrote a paper some years ago called "Are You as Smart as a French Peasant?" I'll leave it there.
Yeah, the Napoleon d'Or is the favorite coin of the French peasant.
Do we have some more questions? Oh, we've got lots of them. Please, Dr. Rohr.
You raised a number of issues as to how one is to own gold, ETFs, mining, physical gold. I'd love to see a little debate among the three participants. At least, you've all given the reasons why you should own gold in the way you've suggested, but how about being negative about the other ways of holding gold?
Well, let me start by saying that, when you're buying gold, I think you first have to ask yourself, why are you buying it? Do you want to have a physical asset, or do you want to just own exposure to the price of gold? Those are fundamentally different things, because you're talking about a tangible asset in one case and a financial asset in the other. So you first have to ask yourself, why do you want to own it? And then you can determine whether you want the two types of gold, physical gold or paper gold, because they, like any tool, they can be used properly or they can be used incorrectly. So, despite the fact that people say that, I'm anti-ETFs, I'm not. I'm just saying that, recognize that an ETF is a tool if that fits your need, but also recognize that physical gold is something different from an ETF. Because when you own physical gold, you own gold. When you own an ETF, you own shares in a fund. Those are fundamentally different things.
I mean, I would just, the problem we're going to be very unsatisfying for you, because I'm not sure we actually disagree that much. I mean, it really is a function of what you're doing. I don't think I've ever heard you say ETFs are a sham and there's no gold in the vault and it's all going to hell in a handbasket. That I would probably have some disagreement with. They are fundamentally different. I think that the idea of owning a financial asset versus a physical asset is really the core distinction here. My argument is simply that I think many people feel like they own a physical asset when they're actually just owning a different paper trail to a thing that they don't have in their hands either. If owning physical gold is really important to you, then taking personal custody of it is the only way to actually be sure, right? I mean, you have to be the the prototypical guy with the space in his freezer for it. I mean, I wouldn't recommend that as your particular custody strategy. But
I will say one thing, though, about the ETFs that, it's just food for thought. If you read the prospectus for GLD and you look at the assets on the balance sheet of GLD, it doesn't say gold. It says investments in gold. Now, that's very, very significant because gold is different from an investment in gold. An investment in gold is something that allows an auditor to say, yes, there's a piece of paper here actually saying this gold exists or somebody's committed to deliver that gold. If there actually said gold on the balance sheet, the auditors would have to go into the vault and actually prove that the gold exists, which is what we do in GoldMoney. So, again, there are issues there that, I have problems with when people say, oh, well, owning GLD is like owning physical gold. It's not. And you have to understand these subtleties because it can make a difference as to whether you're accomplishing your objective to buying physical gold or paper gold.
There's several questions. I want to keep going around the room first. I will get back to you, I promise. The gentleman in the blue shirt.
Actually, I have questions for all of you, but the one that's probably most universal for Robert. On your chart, you said that China is now the #1 producer. So my question is, how do you see the impact of a, shall we say, very self-interested government now being the major player amongst all these, private entities, and how does that bode for those stocks, or that as how those are going to relate?
It's a very good question. China is not the only, or not the largest producer only of gold. It's the largest producer of coal. It's the largest producer of iron ore. It has a dominance in the commodity sector that most people don't appreciate because we don't think of it that way. But China and India are the two biggest players in the commodity space right now. So you're absolutely correct. The central government of China is a player in gold, but I'm not going to predict whether it's a good player or a bad player at the moment. I haven't seen any adverse effect in China because of its particular political leanings. But it points out again that gold, because it's mined all around the world, has a political aspect to it that you have to take into account. I mean, when you see securities up on a chart, everybody thinks of a security as, a company based in the U.S. or Canada, maybe Australia, with a board of directors, and every company is more or less the same. And that's true to some extent, but with respect to mining stocks, where they mine and the political environment within which they mine makes a huge difference. I think you've heard that from almost everybody here.
How about finance houses of hedging the risk of the individual mine?
Well, I haven't seen so much in terms of hedging of individual mines, but definitely there's hedging by companies. And as one of the speakers mentioned, the big gold companies were primarily in the business of hedging up until recently, and now they've gotten out of hedging for the most part. So they're pure plays in terms of gold producing. Various investors hedge their positions.
It wasn't actually my question.
Sorry.
Was to the extent that the finance houses owning and financing many mines spread the risk, so you can buy the finance houses as opposed to buying the mines directly. That was the question.
Yeah, well, okay, I didn't understand, I'm sorry. You're absolutely correct. In gold in particular, loans that are made to companies that are in gold are often then syndicated or spread out so that the risk is hedged. And I think it's a phenomenon that's not limited just to gold, because that happens with respect to almost all financing arrangements, but definitely it's part of what you see in the gold space.
Question back there?
Yes. In view of the recent rapid rise in gold prices, could you all comment on the aspect of gold, the bubble aspect of this, for someone who is considering establishing positions in gold at this particular point in time? Are we really at a bubble that could potentially burst, or is it just going to continue to rise?
No, this is an excellent question. And in fact, I'd like to dovetail a similar question that was put to us through an email. It was a little more specific and it's a little bit more painful, but it speaks to the bubble nature of things. The question is as follows. If gold is considered a classic store of value, how does one defend its price performance from September 1980 to August 1999, when on average it declined by 5% a year, in a world where the CPI inflation, in fact, was rising? Well, that happened to also be a period that followed a bubble, but that is a long period of time. And are we at the doorstep of something similar to that, with gold having run up to the high levels that it is currently at? I hope that doesn't mess up your question. Does that still capture the spirit of it?
The question, it could be looked at either way. I'm just curious about, at the present time,
Right.
the idea of the bubble aspect.
Well, so guys, here's the depth charge.
Yeah, I get this question a lot recently because of all of the media attention and the word bubble being used. When you look at gold, or when you look at any asset, the price is not the important thing. What's important is the value. And price is different from value. Assets can be undervalued and assets can be overvalued. The key to successful investing is to acquire undervalued assets and then get rid of them when they become overvalued. Now, in 1980, gold was overvalued by all of my measures. And if you want to look into this in more detail, do a Google search for James Turk Fear Index, and you'll see a mathematical model that I use to determine whether gold is overvalued or undervalued. Now, over the past 10 years, the price of gold has risen by a factor of, 6? But gold still remains undervalued because the dollar is being debased, inflated away over this period of time, almost as rapidly as the price of gold is rising. So, when the media starts talking about a bubble, that means we're still very early in this bull market. When the media starts saying you should be buying gold, that's the time you're going to want to be getting rid of what you're accumulating now. And that raises another important point, because I often get the question, well, if I buy gold, how will I know when to sell it? Well, again, you have to focus on whether it becomes overvalued at some point in time in the future, as gold will be. And my estimate is it's probably going to be 2013 to 2015. There's an interview I did in Barron's back in 2003 when I forecast that the price of gold would be $8,000 an ounce in 2013 to 2015. And at that moment in time, it would probably become overvalued. We'll see. We're headed in that direction, and whether it's that price or a lower price or a higher price, only time will tell. But this time around, it's not going to be like 1980. When gold becomes overvalued, in my view, you're not going to sell it, you're going to spend it. In other words, gold is going to become currency once again. And when that happens, you're going to want to take the gold that you've been accumulating these past several years, and you're going to spend it to buy investments, to buy assets of other sorts that are undervalued. And you ride the next cycle until those assets become overvalued as well.
Yeah, there was a great article on the NPR website on their money blog today about sort of talking about the historical peak in dollar-adjusted value of gold, which was back in 1980. And they had the quote from the Wall Street Journal on the day that gold closed at the highest ever adjusted London PM fix, and it was that gold, while high, remained the single best commodity play for the next 5 years. Now, I mean, it's easy to cherry pick those kinds of things, but in a sense, you're right. As soon as everybody in the media is absolutely piled on and said, well, this is it, the only thing you can own now is gold, is probably the day that it's gotten overvalued and you should do something else with your money. I would just comment two things, sort of answering the CPI question. One is, and I know this is controversial in an economics group, but I think the CPI is becoming a largely irrelevant and over-manipulated figure for measuring the actual value of the US dollar in any meaningful way. So I have a hard time looking at any data about the CPI that goes back more than 5 minutes and taking it with anything but a grain of salt. And similarly, I think that gold has changed its role in the world's financial system in the last decade. Again, Steve Cunningham and I were having a discussion about this last week. The role of gold as a financial asset is now entrenched in the market. Whether it should or shouldn't be, we're talking about gold as a portfolio asset. That's a relatively recent shift in not just individual investor mentality, but in institutional and hedge fund and global trader mentality. Consequently, I would argue that if you look at gold pre, say, 1999, 2000, and gold post, there's a series break. So all these analysis, and I'm guilty of this too, I put up the same kinds of charts. All these charts we look at of what gold did up to 2000 versus how gold is performing now as a portfolio asset, I really do think there's a series break that happened. And whether that's the rise of ETFs or whether that's just simply, you know, the sort of horrible 10-year period we've been through here where, you know, system after system seems to fail us in the financial markets, that series break makes it extraordinarily difficult to say whether or not gold is over or undervalued. I would actually argue gold's probably a better indication of real inflation than any metric we've been using in this country, right? I mean, that's actually sort of the point that you're making is the reason gold is so expensive is because that's actually showing you what inflation is.
Take a crack at answering your question also. Prices reflect information, and information is news. News comes randomly, therefore prices change randomly. That's our view. That's the rational market view. Having said that, do prices, are they subject to speculative excess? Yes. And it's always obvious as long as you're looking in the rearview mirror when those episodes occur. We can't predict these things in advance. I don't know anybody who can do it consistently. So our approach is to simply, if you're launching a portfolio now that includes gold, figure out that range of 5 to 10%, figure out which way you want to hold it, and simply rebalance as conditions warrant. Should the price fall, you can add a little more. When the price rises, you sell a little bit, invest in other holdings.
Yes.
Question for you, and the question I wanted to ask earlier. Would you rebalance gold like you just described? I'm sorry, would you rebalance gold in a portfolio like you described? And let me ask you why. You're in Zimbabwe and gold is 5% of your portfolio. And it becomes a bigger and bigger percent of your portfolio. You keep rebalancing and finally you end up broke. So is rebalancing really an intelligent thing to do in a gold in a portfolio if you've got the potential for hyperinflation, and that's what you're trying to protect against?
It depends what you're doing with it after you've sold it. If you're just going to put it in a mattress, then that's a pretty bad strategy. But if you've taken the money off the table, as it were, and invested it in other assets that aren't necessarily subject to hyperinflation, that's a different story. So if you're buying, say, international stocks, is the thing that went down, quite a reasonable thing that may have happened. If you'd been sitting on a 10% allocation of gold, the trigger hits, you sell some of that. What's gone down in the last year? Well, IFA, you put some in international stocks. That has its own characteristics of potentially being protected from hyperinflation in the US dollar.
Not so. If you look at the hyperinflation, let's say just in Germany in the early 20s, what you find out is the best thing was be out of the currency. The best thing was gold. The second thing was best be out of the currency. Real estate, domestic real estate, commercial real estate lost a lot of money, eventually made up some of it. Residential real estate lost a lot because they put in price controls or rent controls. Actually,
but how did U.S. stocks do in that environment?
Didn't protect you. Didn't protect you. I mean, getting out of the currency and into other things helps, okay, if you can do that. But many times you have exchange controls and you can't get out. So that's why I raised the issue of rebalancing. I think it's a provocative issue to think about.
Right. And I mean, if the real thrust of your question is rebalancing a good idea, which of course is what is advocated in modern portfolio theory, the answer is yes. But when you talk about very special situations like Zimbabwe or the hyperinflation in Germany, one is not managing their money any longer by the same rules that you would use in more normal times. So it's in a way, it's an unfair question because nobody has one formula good for all time, all circumstances, all events. That's my hedge. Gentleman in the back.
I noticed in one of the charts there was sort of a break between, there's like a full correlation between gold and the gold mines, and then more recently it's sort of the gold mines return less. I was wondering if there was a feature or something happened when the gold mines started returning. The chart showed the gold mines being much lower. I wasn't sure if there was an event or an occurrence.
It was 2008. It was right, the equity premium collapsed. right? Nobody wanted to be in anything that looked like a U.S. stock or an international stock or anything else that looked like a stock, right? So gold actually retained a fair amount of value because it maintained that source of a safe haven, and everybody sold all their stocks, including their gold miners, right? So that's the problem with miners is you're buying a stock, right? It's going to behave like equity.
But the difference actually goes back further than 2008, and it did it for a specific reason. Input costs were rising faster than the gold price. So as a consequence, margins of the mining companies were being squeezed. The second thing is that the mining stocks were in a bear market. The bear market started with the collapse of Briox in 1997, and it didn't end until 2008. We're just now starting a bull market in the mining stocks. So sentiment was also negative to the mining stocks over that period of time. But things are changing now, and if you're inclined to make investments in the mining stocks, I think this is a very good time to do it.
You know, it's interesting, though, that in 2008, when we hit the wall, the only area in which there was any activity in the mining sector in terms of transactions, either M&A or issuances, was in gold. And I think it was that counterbalance that gold presents. So for about a year, you couldn't get a deal done in any other metal except for gold.
Other questions? The lady in the second row.
A question for Mr. Turk. Given the direction that we collectively are taking toward the destruction of the fiat currencies, do you actually see this system as it is now more or less holding together until 2013 to 2015? And if not, what sort of changes do you foresee?
It's a good question. I take it one day at a time. And what I see happening now suggests that maybe it's going to happen before 2013, 2015. But don't underestimate the power of government and government propaganda to convince people to hold fiat currency and that everything is okay. So, you know, maybe it is still a couple more years before the present system, you know, destructs. But destruct it will, because we're on the wrong path. We're not on the path that the framers of the Constitution put us on.
So what replaces it?
Don't know. I can't predict the future. But you'll see that throughout monetary history, events occur that require a dramatic change. My own view is that gold will remain money. It will become currency, but in a digital form. You know, right now, I can use my iPhone to click gold from my holding to your holding if I were to purchase a good or service. It's an entirely new type of currency. So the market will decide. We just have to prepare for all of the eventualities, and one of the best defensive mechanisms to do that is to own physical gold.
Does the landlord set a limit for us on how long we can keep the Q&A going?
No.
All right, so we have a few more questions, and I'll have a little closing comment. Sir.
I have a rather simplistic question for Mr. Turk, and that's about the pounds or tons of gold that are available. Your charts and yourself, you were implying that the fiat currencies should be replaced and we should go back to gold. You didn't actually say that, but you were implying that. But if you did that, with the volume of people that we have in the world and the number of countries and companies and the amount of transactions that take place, is there enough gold to accommodate that?
Yeah, it's a good question. An ounce of gold still buys the same amount of crude oil as it did 60 years ago, even though we've had a lot of growth during that 60-year period of time. An ounce of gold still buys a Colt 45, just a pistol, just like it did in the Wild West. It was an ounce of gold. I've been told that an ounce of gold, which today can buy a man's suit, could also buy a toga for a Roman senator. What you have to remember is that this above-ground stock of gold grows by about 1 3/4% per annum, which is approximately equal to population growth and new wealth creation. So it will accommodate the growth of economic activity and the growth of wealth throughout the world, which actually brings up another point. Robert made the point that gold does not have an industrial use. He's exactly right. But gold is not a commodity. There is this group of assets out there called tangible assets. A house is a tangible asset. Commodities are a tangible asset, and gold is a tangible asset. But it's not a commodity. Commodities are produced, consumed, and disappear. gold gets produced, it doesn't get consumed and doesn't disappear. All of the gold that's ever been mined throughout history still exists in its above ground stock. Now, why does it do? Why does this happen? Well, it gets back to the point, well, why do things have value? You know, things, if they have usefulness or utility, people will, accumulate it, or they'll do something with it. They'll find it useful. Now, gold doesn't have any industrial uses for all practical purposes, but it does have usefulness in economic calculation. It can determine the prices of goods and services over long periods of time, which is a very important function because the entrepreneur and the businessman has to be able to judge whether he's employing his capital in a proper way. And when you have a fiat currency moving up and down all of the time, that's very difficult. And as a consequence, you get a lot of malinvestment under a fiat currency system if you don't have a sound currency to work with. So, gold is money. It's not a commodity. It has value because it's utility in economic calculation and preserving purchasing power over long periods of time.
Could I follow up on that?
Wait.
If we went back to the gold standard, could we still have paper to do our transactions? Could we still do transactions over the telephone or with credit cards?
Yeah, we could, but going back to the gold standard, I don't think it's going to happen, and I don't advocate it. Governments have done such a poor job of managing currency. Do we want to give them the ability to control a gold standard once again like they did back in the 17th and 18th and 19th centuries? I think governments have so badly mismanaged it. I think very few people will actually trust government managing a gold standard. There's a more fundamental issue. I'd rather turn to the private sector and the marketplace to develop some currency in the future. It's more likely to be more efficient and won't be used as a political weapon. It will create a level playing field that anybody can use on a voluntary basis, which is the essential nature of our society. It's interacting with everyone else on a voluntary basis to improve our situation, to fulfill our needs and wants as we go into the marketplace. And to do that, you need a level playing field in money, and private market can probably do it better than government. Not probably, will do it better than government.
What is that level playing field then? Describe it.
The level playing field is that an ounce of gold is an ounce of gold is an ounce of gold. It's an unchanging unit of account, so that you're working with a constant measure. If a carpenter one day had a foot when he's measuring a house as a certain measure of distance, then the next day it's less, how is a house going to be built? You have to have a constant unit of measure, and that's what sound money is all about. Sound money is not keeping prices unchanging. It's impossible in the real world to keep prices from unchanging because there are four forces at work: supply and demand of money, supply and demand of the good and service which you're evaluating the price of. So fluctuating prices are a reality. That's just something government propaganda uses as a power to give central banks to try to control the money supply to keep prices constant. But constant prices are an impossibility. Yes. Good.
Yes, I have a question.
Sorry. You're very popular.
Following up your last comment, it seems to me that there's another issue. If it was a perfect world, gold prices would function in a perfect economy. But there's so much noise about the manipulation of gold prices, and particularly through the COMEX and various other organizations. There's an awful lot of noise that the U.S. government is certainly trying to discourage ownership of gold by American citizens. And it seems to me that there's a lot of effort to prevent or reduce or control the free market of gold. And I'd like to hear your comments about that.
Well, you're absolutely right. There is a lot of noise. But don't let that noise distract you from acquiring an undervalued asset, because at the end of the day, the free market is much bigger than any government or group of governments, and ultimately the value of that asset is going to be realized. Gold's been up 18% per annum on average over the last 10 years, despite this intervention, despite the anti-gold propaganda, despite the fact that there are all kinds of impediments from acquiring gold or using gold as a form of money or currency. The market is speaking. We have to listen to what the market is saying. And the market is saying that gold has been money for 5,000 years. This 40-year experiment with fiat currency seems to have a wheel coming off the cart. And is that 5,000 years going to be, is it worth nothing anymore? Or are those attributes that made gold as money in the first place still there and just being ignored or forgotten? I think they've just been ignored and forgotten, and the fact that the gold price has been rising is an indication that the marketplace is starting to relearn why gold became money 5,000 years ago and remained money until 40 years ago.
The United States has enjoyed 250 plus years of extraordinary economic and political tranquility. And we've all gotten used through the literature and through our personal experiences with the concept of stability, and that you can count on certain things, law and order and ownership of property. But little by little, all these pillars of assumptions that we've lived by almost unthinkingly are being chiseled away. I mean, who would have thought that a manipulation could occur that could lead to a collapse in home prices of the magnitude we just experienced? I mean, don't even think about gold for a minute. I mean, how did that happen? Well, I don't want to answer the question, but you know very well that it has to do with intervention in the marketplace by various government policies. So we can't make any good assumptions about the future. In fact, the poet Paul Valéry said that the future isn't like it used to be. And therein lies the importance of all of us thinking very hard about how we want to protect ourselves, whether gold is an enigma, whether it's an investment, or as Ron Paul tried to get Bernanke to say is gold money, and he said, no, it's a sort of habit. It is a numeraire. It is a store of value and a numeraire by which you can judge the value of other things. And there are no simple-minded formulas that should tell you how much you should own or how you should rebalance it in your personal decision-making. But clearly, if we go into a protracted period of political and economic instability, which we seem to be at the doorstep of, then it would argue for all of us having a significant amount of gold in our balance sheet. And with that, thank you.